this tutorial, I will demonstrate how effective we speculators can identify false market moves and basic retracements. The structure of a reversal is almost always the same, and once the clues line up, it's easy to catch. You will find the major move initiated on the back of a significant event or piece of data. Whatever the origins of the search, it needs to hold true throughout the pullback, in which case we can identify a retrace as profit taking and liquidity search. Profit taking and liquidity searches have no follow through in the face of supportive data in the background. For the next news article, I will examine how to identify these individual components and call a reversal trade. Headline reads, Dollar claws back early Fed-driven losses. It is the 27th of July, 21 o'clock, British summertime. Titles are Euro-dollar back below $1.17 after reaching highest level since 2015. Focus stays on Federal Reserve policy outlook. Tech retreat topples S&P 500 and Nasdaq from record highs. Brent oil at 6-week peak above $51 a barrel. Treasury cede some of the Wednesday gains. Here we already see where market is focusing on. It stays focused on Federal Reserve's policy outlook that they had on Wednesday. In this article we get a bit more insight on what happened on Wednesday, whether on the Thursday. It says that the main reason market rallied on the Euro-USD was on the back of a dovish Federal Reserve, who changed their wording on the inflation outlook from somewhat below target. They changed it to below, and market took it as dovish remarks, and therefore the USD sold off. Further on, an analyst comments that investors continue to speculate that the Fed will change its stance to take a dovish turn soon. It was a shift in the language around inflation instead of the Fed's balance sheet policy guidance that caused the subsequent market volatility, which in turn means the market is probably looking out more on the rate outlook surrounding probably December rather than the balance sheet, which is causing USD to sell off. Further on, analysts say as well, this will muddy the rate outlook for December and during 2018. The journey to a neutral Fed funds rate has so far had a relatively easy ride, but it's headed for more bumpy terrain. Reading further down the article as well, it explains that why the European Central Bank might want to keep the euro a little bit lower. However, it's backed up with no data and it's more speculative rather than anything ingrained in the market itself. Equities were coasting along as well, and we had a bit of a mixed performance on the commodities. Reading all of that, we can see that dollar clawed back some of its gains, but with little conviction why it should continue to do so. On the other side, we can see the euro-dollar has got a bit more upside as the Federal Reserve is starting to get dovish, and a continuation in euro-USD is more likely on the back of those remarks. Hence we will be looking to buy the dips. Upon reading the article, you would find yourself with this 4-hourly candle here, which coincidentally is a 4-hour inside bar as well. Now it is evident that the Federal Reserve's announcement created this demand imbalance, so we're going to mark that as well. And following the next day, market traded back into it and bounced. So you could have approached this in two different ways. Either you would want to enter a market off from that demand level by keeping your risk management somewhere behind these latest squeeze points, or you would want to trade the breakout of this inside bar. Now further was evident that not only did you have the next day's flows in your hand, but also the following days. You were trading all along with the flow and on the back of the right sentiment. Now, trading in this way and catching the right reversal is very crucial, because understanding when price is moving just on the back of liquidity searches or on the back of profit taking while you're looking to enter long-term trends comes in very handy, because then you know where you can safely and securely add to your trade by keeping your risk management very neat and tight.